a.m. we get a powerful trio of labor data. The S&P 500 closed last week at a new all-time high. At the moment, holding US dollars appears less attractive to investors. We expect this bearish momentum on the DXY to continue throughout the week. Welcome to this week's market update. I'm Isaac Martinez, trader and analyst at XChief. In today's video, we're diving into the key economic events that could shift the markets, analyzing rising geopolitical risks, and breaking down the latest price action on the dollar index, S&P 500, Euro USD, and Bitcoin using real-time charts from TradingView. Whether you're a new trader or a seasoned investor, this analysis is tailored to help you navigate the week with confidence. Let's get started. This week kicks off on Tuesday 1st with a key speech from Fed Chair Jerome Powell at 8:30 a.m. Traders should listen closely as any hints about future interest rate moves or the Fed's view on inflation could shake the markets. Then we have the ISM manufacturing PMI. This tells us how strong the manufacturing sector is. If this number shows weakness, it could signal a slowdown in the economy. Just 30 minutes later at 9 a.m. we get the JOLTS job openings report. This gives us insight into how many job positions are still unfilled, helping investors understand how tight or loose the labor market really is. Moving into Wednesday, July 2nd, at 7:15 a.m. we get the ADP non-farm employment change. This is a private sector estimate of how many jobs were created, and it's often seen as a preview of the bigger government report coming later in the week. Then on Thursday, July 3rd, at 7:30 a.m. we get a powerful trio of labor data: average hourly earnings, non-farm employment change, and the unemployment rate. Together, these numbers tells us how many jobs were added, how much wages are growing, and how many people are unemployed. Strong figures here can push markets, especially if they surprise expectations. Finally, at 9 a.m. the ISM Services PMI will be released. This shows the health of the services sector, which makes up most of the US economy. It's a key indicator that could influence how investors feel about the broader outlook. No events are scheduled on Friday, July 4th, due to the US Independence Day holiday. Now moving on to the fundamentals, the S&P 500 closed last week at a new all-time high, supported by easing geopolitical tensions, solid economic data, and growing expectations for interest rate cuts. The index gained 3.48% on the week, bringing its year-to-date return to 5.65%. However, the strength of this rally has raised questions about how sustainable it really is, especially with markets already pricing in a dovish shift in policy and global risks still present. According to Seven's report, the rally is mainly driven by confidence that the current administration won't take any actions that seriously harm the economy, despite ongoing tariff threats and aggressive political rhetoric. Markets seem to view this as part of a negotiation strategy rather than a real threat to economic growth. At the same time, fears of stagflation have faded. Declining energy and housing prices are helping to ease inflation pressures, offering some relief to investors. Growth data remains solid too. Flash PMIs for June came in stronger than expected, reinforcing a positive sentiment. Tech stocks once again led the way, fueled by ongoing enthusiasm around artificial intelligence, and while current valuations appear stretched based on 2025 earnings, analysts are shifting toward 2026 projections, which make the market look more reasonably priced. Still, the outlook is cautious. The report warns that growing signs of weakness in the labor market could quickly derail this rally if fears about slowing growth start to build. Last week's jobless claims were mixed, and investors will now turn their focus to upcoming data, especially the jobs report and ISM PMIs. Now let's begin the analysis of the most important financial assets, starting with the strength of the US dollar, represented by the DXY index. On the 4-hour chart, chart, we've seen continued weakness in the dollar with a persistent downtrend marked by ongoing corrections. This is likely due to recent economic reports, ongoing geopolitical tensions, and concerns surrounding interest rates. At the moment, holding US dollars appears less attractive to investors. We expect this bearish momentum on the DXY to continue throughout the week. However, some caution is needed as we may see a potential rebound in the coming days, possibly toward the 97.602 level. This area represents a liquidity vacuum block, as we can see right here, which the price could attempt to fill before resuming its downward trend. If you're still holding a bullish outlook on the dollar, I believe we should focus on key liquidity zones where price could recover. These include the levels at 98.201, 98.836 and 99.193. But be careful, unless we get strong economic catalyst, it's unlikely we'll see significant upward momentum. Instead, we should shift our focus on the daily and weekly time frames to better identify the broader trend. Based on the current structure, the primary bearish target for the DXY remains at this liquidity zone located at 95.156. Now let's continue with the S&P 500. We've just seen the index reach a new all-time high. As of Monday, June 30th, the chart still shows a bullish trend, and so far we haven't seen any significant correction during the early trading hours that we've been monitoring and trading. However, caution is key here. We can't simply jump into a long position knowing that we are at all-time highs. It will be more prudent to wait for a pullback, potentially toward a liquidity gap or fair value gap, as we can see here with the most reactive zone around the 6,042 level. That could offer a safer entry point to continue riding the bullish momentum. If that area isn't reached, the next key liquidity zone we are watching is around 5,943. A reaction from there could also provide a viable opportunity for a long setup in the S&P 500. On the other hand, our bullish targets remain at 6,198, a level that's not far off now, especially considering previous Fibonacci retracement projections. With that said, we continue to maintain a bullish outlook on the S&P 500. Now turning to the Euro USD, we've seen continued strength in the euro, closely tied to its inverse relationship with the US dollar. Most likely, the pair will maintain its bullish momentum, and we should continue setting new upside targets on the daily chart. The first key resistance level that we are watching right now is located at 1.19091, and if the bullish trend continues, the next potential targets are at 1.22666 and 1.23496. Personally, I would focus on the 1.19091 level first, and then look for further upside moves toward those higher targets once we see a confirmed breakout. As for possible bearish movements and downside levels to monitor for pullbacks or corrections, I would consider the following zones: 1.14463, 1.12105, 1.11311 and 1.10656 for a liquidity sweep or market manipulation setup, potentially giving us a better entry for a long position on the euro. Unfortunately, this is not good news for those holding US dollars, but we must acknowledge that the bullish momentum for the euro could continue, especially if there is no strong economic response or key fundamentals coming from the US economy. Lastly, let's focus on Bitcoin. We're seeing a clearly bullish movement and a strong recovery in the price of this asset. It's highly likely that the uptrend will continue. If the current consolidation range fails to hold, the price will most likely break upward and resume the bullish structure. There are several reasons supporting this upward move, most notably the recent liquidity sweep that occurred around the daily low at this point, which is located at 100,377 level. This zone acted as a liquidity pool and has now been reclaimed as a support. With that manipulation, the market seems to have gathered enough liquidity to fuel further bullish momentum. Our targets for this week are set at $109,000, followed by $110,651, and ultimately a new all-time high above $112,000. As I mentioned earlier, if we don't remain within the current range, the bias still favors the continuation of the bullish structure. On the downside, a clear bearish target lies in this fair value gap around 104,075 USD. Should the correction deepen, we would then look at the 99,677 and finally 98,225 USD as a critical support zone to hold, especially if we still believe the price can continue its upward trajectory. This wraps up this week analysis. If you found this video helpful, don't forget to like, subscribe, and turn on notifications so you don't miss future updates. And if you haven't already, register at XChief.com to access professional tools and a reliable trading platform. See you in the next video.